All right. So yesterday we talked about how we deal with our uncollectible accounts. We talked about the direct write-off method, where when we decide somebody's not going to be able to pay us, we will do a journal entry to claim that amount they're not going to pay us as an expense, right? And then reduce the accounts receivable. So we debit bad debt expense and we credit account receivable. We also learned how to reverse that if somebody came back and paid us later after we, thought they weren't going to pay and we wrote it off, then we could reinstate it and then pay it off. And then we learned about this allowance for doubtful accounts method, which is a little bit weirder in that it lets us take the expense at the end of the year, even if we haven't decided who's going to pay us and who's not going to pay us, but instead we estimate how much we're not going to be able to collect during, from this year. We take the expense at the end of the year, and then in the following year, we'll do journal entries against that allowance we created. So I mentioned that one of the challenging things about this allowance method is that we have to decide how to estimate how much people aren't going to be able to pay us, right? So if I sell $1 million worth of stuff on credit this year and we get down to the end of the year and I've got maybe 200,000 still owed to me, and I want to say, take the expense for this year, how do I decide how much of that 200,000 is not going to be collectible? And the answer is usually from past experience, right? You say, a certain percentage of the amount I sell, I'm just not going to be able to collect based on previous experience, maybe 1% or something like that. Or you can say, look at the amount that's receivable and say, past experience tells me that a certain percentage of the amount that's receivable at any given time is not going to be collectible. So today we're going to talk about these methods we use and how we do the accounting for them to estimate what's not receivable and how we enter it into our system, okay? So the first method we can use is called the percent of sales method. And from its name, you could tell it has something to do with taking a percent of the sales, right? You can tell from its name, which means really that our past experience tells us that a certain percentage of the sale make are going to end up being uncollectible, meaning the customer is going to contact us for some reason and say, hey, I can't pay you, or the customer is just going to ghost us. And then we're going to say, I don't think I'm ever going to get paid on this, so I'm going to have to write this off as an expense. Okay. So what we do for the percent of sales method is honestly, the problem in real life, you just have to decide, right? You get all the people together who are the decision makers and say, here's what past experience tells us. We want to just write off. This one says 0.75% at the end of the year. We'll look at what our sales were, multiply that by 0.0075 or 0.75%, and that'll tell us how much to take as an expense for the year for bad debt, and how much to put to that allowance for doubtful accounts. So here's our information. The Xtone company, they have a balance on their accounts receivable of $240,000. So people owe them $240,000. And they have a balance on their allowance for doubtful accounts of $3,250, a credit balance. Their total credit sales for the year were $3 million. And their past experience tells them that their bad debt as a percent of credit sales is 0.75%. So this is a lot of buildup. It's kind of like when someone has a huge buildup with a joke and then it's got a really lame punchline. This is a lot of buildup for a really easy problem, okay? So all we do is take, with the percent of sales method, is we take the sales, $3 million, times the percentage. Again, in these problems, they give it to you. It's the percentage we think will be uncollectible. So 0.75%, and that gives us $22,500. And so all we do at the end of the year is we do this adjusting entry where we debit bad debt expense, $22,500, and we credit the allowance for doubtful accounts, $22,500. That's it. So this one's pretty easy. You just need to know the amount of sales and the percent that you think will be uncollectible. Multiply the amount of the sales times that percent uncollectible. It gives you the amount, and then you debit the expense, credit the allowance. Then throughout the year, the next year, We did this at December 31st, 2022. Throughout 2023, when we decide somebody's account is actually uncollectible, like they're not going to be able to pay us, then we just debit the allowance for doubtful accounts and credit their accounts receivable. So we're taking their receivable off, but we're not taking an expense for it because we already did at the end of the previous year. The idea is we'd like to take that expense for bad debts or bad debt expense during the year in which we sold the stuff to people and created that accounts receivable, instead of pushing it into the next year where it doesn't make any sense. Okay, so that's why we do this allowance for doubtful accounts method. So that's one method. It's the percent of sales method. Okay, so we're going to do a problem in the guided assignment to see how that plays out in the actual problem. All right. So at the end of the current year, accounts receivable has a balance of $4,375,000. Allowance for doubtful accounts has a debit balance of $21,300. And sales for the year total, man, that's a big company, $102,480,000. Nice. Would you like to have $102 million? I'd settle for 1 million, but I mean, if it's like you can have 1 million or 102 million, I pick 102 million. All right. Bigger is not always better, but when it comes to dollars, usually. All right. The bad debt expense is estimated at 0.25% of sales. All right. So to figure out how much our bad debt or how much of a adjusting entry we're going to do, it gives you a ton of information, but the only information that really applies here is the sales. So 102,480,000, and the bad debt expense percentage. So 0.25%. If I did 0.025, that would be 2.5%, right? So I could do 0.0025, and that would be 0.25%. Oh, what did I do wrong? Oh, I did minus. I thought I hit times. They're right next to each other, to be fair. But you'd think after years and years and years of using one of these, I wouldn't make so many mistakes. False. Times 0.0025. So $256,200. So what we're saying is, if we did $102 million in sales and we believe we're not going to be able to collect 0.25%, this is the amount we believe we're not going to be able to collect. Okay. We would do a journal entry that would look like a debit to bad debt expense and a credit to the allowance for doubtful accounts. That's what that would look like at the end of the year. That would be our adjusting entry. So now they want us to determine the adjusted balances for accounts receivable, allowance for doubtful accounts, and bad debt expense. So they told us that our accounts receivable has a balance of 4,375,000. I'm going to assume that's a debit balance, since that's the normal balance for an asset. Accounts receivable is an asset. The allowance for doubtful accounts has a debit balance. So this one, it tells us, right? So the allowance for doubtful accounts, that's not the Americans with Disabilities Act. That's business law, different class. Okay. The allowance for doubtful accounts has a debit balance of 21,300. And then sales for the year, we don't need that. All right. So it says determine the adjusted balances for accounts receivable. So if we had a balance of 4,375,000, and I just said that this adjusting entry, the 200, what was it, 256,200 is going to look like this. Bad debt expense on the debit side, 256,200. And the allowance for doubtful accounts, credit 256, 200. So if this is our adjusting entry, then the accounts receivable did not get changed by that entry, right? So the balance of accounts receivable, even after the adjustment, still going to be 4,306,000. Does that make sense? So what they're asking us to do is figure out the adjustment. They didn't tell us to, but we had to figure out what the actual adjusting entry would look like, a debit to the bad debt expense and a credit to the allowance for doubtful accounts. And now they want to know after this adjustment right here, I'll put a line here because it's confusing. After that adjustment right there, what's the balance of the account? So accounts receivable didn't change. So it's 4,375,000. But the allowance for doubtful accounts, it did change, right? We just credited the account 256,200. So if it had a debit balance of 21,300 and we credited it 256,200, what's the new balance? Anybody have calculator fingers of fury? Shh, I can't. 234,900? Did you do that in your head? Oh, I thought you were being a boss right now. 234,900 is the balance for our allowance for doubtful accounts. And then our bad debt expense, we assume, it doesn't tell us, but most likely it had a balance of 0 because we only use that expense account at the end of the year when we do the adjusting entry, when we're doing the allowance method. The bad debt expense is now going to have a debit balance of 256,200 because it went from 0 and we debited it 256,200. And then question C is determine the net realizable value of accounts receivable. It's a weird word. This chair's in my way. Net realizable value just means of all the money owed to you on this accounts receivable, how much of it do you expect to be able to collect? So all we would do is take our accounts receivable, 430 or 4,375,000, and we would subtract the allowance, the balance of the allowance for doubtful accounts. Whoops. Which was 234,000. What's that come out to? 4,375,000. 4 million. So what we're saying is I'm owed $4,375,000. I have created this allowance because I don't believe I'm going to get paid all of it. So the amount I'm owed minus the allowance tells me how much I believe I'll actually collect, the net realizable value. Okay. Luckily, your calculator skills are on point. Would you rather have calculator skills that are on point or eyebrows that are on point if you could only have one of the two? The reason I ask is one day I was coaching a soccer match, coaching girls high school soccer, and one of my players gets completely burned by a winger on the other team. And I'm like, so like when we have the end of the half, I'm like, hey, like what happened? And she's like, oh, she's fast, but her eyebrows are on point. And I was like, this never happened when I was coaching boys. Never conversations. So apparently women notice this about each other. They're like, like if you get burned by someone with bad eyebrows, apparently that's extra bad. All right. It's better because then you're like, oh, okay, so okay, that makes sense. Or is it like if their brows on point, you're like, pretty sure that was a dude that just burned me, so no harm, right? I don't know. Like, because dudes always have crazy eyebrows. Like, we don't care. All right. My wife occasionally forces me to trim mine. Otherwise, they would just be like that, I think. Anyway, she's like, why didn't you just ask when they cut your hair? Why didn't you just ask them to trim your eyebrows? I'm like, because it's embarrassing, like that. She's like, that's their job. And then that's because that's how we argue. All right. Anyway, let's get back to the math. All right. The second method for estimating, and I will say it is the more accurate method, okay, for estimating receivables that we're not going to be able to collect, is what's called the analysis of receivables method. And here, what we do is we look at the due dates of everything that's owed to us, and we recognize that stuff with an older due date is less likely to be collected. So if something's like 2 years old, the chance that you're going to get that person to pay you still is low. Okay. Whereas stuff that's only like 30 days past due, you usually collect most of that because most people are honest and are willing to pay. And so sometimes they're just like, hey, I can't pay you this week, but as soon as I get paid, I'll pay you. Right. So with the analysis of receivables method, we look at the due date for each account, and then the number of days each account is past due is determined. And then each account is placed in an aged class according to its days past due. Typically, we use the following: 1 through 30, 31 through 60, because that's a month, 2 months, 3 months, then 91 to 180. So 4 months to 6 months, 6 months to a year, and over a year. And again, based on, in real life, based on past experience, you assign a percentage to each of those categories that you think is uncollectible. So we're looking at the money owed to us and then breaking it down in categories by age. And then each of those aged categories will have a percentage that we think is uncollectible. And that percentage will typically get higher the older the debt is. Okay. We then total up each of the aged classes. We multiply each age class by its estimated percentage uncollectible. And then we take the sum or add up the totals of each of those classes. So this is our overall process for doing the analysis of receivables method. And then there's one more quirk with it, which will throw you off, which is why it's important. This is why I saved the second day for just looking at this. When we did this first method, which was the percent of sales method, all we did was figure out the amount, took the percent times the sales, and then we debited or credited that to the allowance for doubtful accounts. So here we credited it. But with the analysis of receivables method, instead, what we're going to do is find the amount, and then we're going to make a journal entry that will bring the balance of our allowance for doubtful accounts up to that amount. So it's really easy to get confused. With sales method, when we're basing our receivables that are uncollectible on sales, we're just calculating the amount of sales that are uncollectible, and we're debiting bad debt expense, crediting the allowance for doubtful accounts for that amount. With the analysis of receivables method, we're figuring out the amount of receivables that are not collectible, and then taking those percentages and bringing our allowance for doubtful accounts up to that amount. Okay, you'll see it when you do it, and you'll be like, oh, that's what he was talking about. Because right now you're looking at me like, I don't know enough to really know what you mean by that, so just show me, right? So, and again, I don't appreciate your tone, but it's the best I can do. All right, so here's an example. You can see what they do is they have all the money owed to them, and then they put it into categories of how many days past due it is. And then what they're showing you here is there's a bunch of other companies listed too. But to give you an idea, like this Brock company is not past due, so it's still within its regular due date. But the BT Bar company, they have an amount that's between 4 and 6 months old, and another amount that's between 26 or between 6 months and a year old. And then Ashby and Company is 31 to 60. So what they do is they then total up each of these columns. So you know the total amount that's owed to you that's not past due, the total amount that's owed to you that is 1 to 30 days past due, 31 to 60, etc. And then in the problem, it will give you this percentage uncollectible. In real life, you would have to meet with the accountants and that and kind of come up with a past, here's how much we think is not collectible. And then you just take the total in each category and multiply it by the percent. And you do that all the way across and see how the percent gets higher the older the account gets. And then finally, you total up all of these amounts to give you your estimated uncollectible accounts. So it's multi-step sort of problem. But the reason we bother to go through those extra steps is because it's way more accurate. Okay. I mean, this really holds true that the older a debt gets, the less likely you are to collect it, which makes sense, right? All right. So we're going to look at, in a minute here. So here's what I told you. The sum of the estimated uncollectible accounts for each stage class is estimated. This is the desired adjusted balance of the allowance for doubtful accounts. So we're going to do a journal entry then that brings the balance of the allowance for doubtful accounts up to that desired balance. Okay. So for X-Tone, they had an unadjusted balance on their allowance for doubtful accounts of a credit of 3,250. They estimated that they weren't going to be able to collect 26,490. So to bring the balance up to 26,490, they do 26,490 minus the balance of the account, and that gives them the amount to actually debit to the bad debt expense and credit to the allowance for doubtful accounts. Okay, so let's go through an example and maybe it will make more sense. Just as a warning, this is kind of a beefy problem. There's like a lot going on in it, okay? So, I always use the term beefy when something's like big and full of mass, right? But I have this steer that we're getting ready to slaughter. And I described him the other day because he's like 1,500 pounds. And I was like, man, that boy is getting beefy. And then it occurred to me that this was the one time when using the term beefy was actually literally accurate because he's full of beef, is he not? But for some reason, because it was so on the nose, it felt like an inappropriate comment. Not inappropriate like in a dirty way, just not like a natural flowing comment. Whereas when I say like, this is a beefy problem, I'm like, I feel that. When I said it was a beefy steer, it felt weird. All right. Well, yeah, two on the nose, exactly. But when I'm eating, his name is Lord Salisbury because we've named like, yeah, like Salisbury steak. We've named a beef related entree after him, like that. Anyway, yeah, my granddaughters are farm kids, so they're just like, like, are you gonna be sad when we kill Miss Piggy? A little, but I really like bacon, like that. So farm kid, right? Like that would be kind of sad. They had a pig named Miss Piggy, and then we had a pig named Pork Cupine. I just call him Cupine. Um, and that was I forget what the other pig's name was, but you got to give them cute names so that when you murder them, you feel the pain of it. You got to appreciate your food. All right, here we go. Ready? So the accounts receivable clerk for Evers Industry prepared the following partially completed aging of receivables schedule. He must be British. Schedule. As of the end of business on July 31st. So here we can see we've got these companies that owe us money. Some of them are more past due than others. The following accounts were unintentionally omitted from the aging schedule. You turd. Now you're making us do your work. And not included in the preceding subtotals. So now we have to determine the number of days past due for each of these. All right. So if July 31st is today's date and something was due on April 7th, we're supposed to do all this math, right, to figure out what day it was due. Here's what I do because I'm lazy. I bring up Excel. I'm lazy AH. It means lazy as heck. Okay, in case you were wondering. I'm a good boy and I don't swear. All right. And then I'm going to put in, like, I'm going to make myself just a little Excel calculator and I'll be like, today's date and due date. And then I'm going to put in like, where'd that problem go? Like, so we know today's date is July 31st. I'll just use this year. Doesn't really matter. And then the due date was April 7th. And then I'll tell Excel days past due, days past due. And then let's be like, this equals today's date minus the due date. And it just tells me there's 115 days in there. To me, that's way faster than, because then I'm like 30 for this month, and then I'm counting on my fingers. All right. So I'm just going to say like 115. Here, the due date was 5/29. That one's 63 days past due. This one is 6/8 or June 8th. August 10th. So that one is going to be like not past due, right? It's going to be like, if it's negative, it means it's not past due. It's due in 10 days, right? So if an account is not past due, enter 0. So I'm going to put 0 there. And then Van Epps, that's 29 days past due. So that's my little cheat using Excel. It's not really a cheat, right? It's just using a tool, which I think is completely appropriate. I'm going to check my work, make sure Excel didn't screw me over somehow, but it didn't. It's forever faithful. All right, Semper Fidelis. If you're a Marine, then that means something different, I guess. Well, it still means forever faithful. Anyway, and now we're going to look at, so now it says complete the aging of receivable schedule by adding the omitted accounts to the bottom of the schedule. So we already had like these accounts in here. So we're going to look at like Boyd Industries is 115 days past due and they owe us $36,000. So I'm going to put Boyd Industries at over 90 days, right? Ooh, how much was it? I forgot already. 36,000. So they're over here in the over 90 days past due column. Does that make sense? Yes, no? I see lots of like concerned looks. Hodges, 63 days past due, and they owed 11,500. So I'll go Hodges, 61 to 90. And then again, I already forgot how much they owe me. Yeah, it was 11.5. Kent Creek is 53 days past due, and they owe 6,600. So I'll go Kent Creek. Put them over here in the 31 to 60. And now I have to remember, what was it, 6,600? Lockwood Company is not past due, and they owe 7,400. So I'll put them here in not past due. And then Van Epps, a good Dutch sounding name. They're 29 days past due and they owe me 13,000. So I'm gonna put them in the 1 to 30. And would I say 13,000? So all I've done is I've categorized, right, all of those past due accounts receivable, put them into the right columns. And now I have to do a total for each of these columns. So balance, this is weird, but what I'm doing is I'm adding up all of these in this row and putting them over here because it's the overall balance. So Hodges, 11,500. In other words, that's the total amount each of those companies owes me in the balance. And then over here on the right of it, we're breaking down how many days past due that is. And now I'm just going to total all these columns. So I'm going to take the subtotal from before and add any amount I've added. So that's going to be 607,400. 233. So I'll give you guys a few minutes. And if you have questions about it, you can ask. Otherwise, like once you get used to this, it's not hard. Like it makes sense what they're doing there. They're just figuring out how much past due each client is, putting them in columns by how past due it is, totaling up those columns to figure out, we know we're owed $1,124,500, and then this breaks down 607,400 isn't past due, etc. You guys ready for me to move on to the next part? I'm not seeing anybody being like, stop. What, Gabby? To where? Good? Or you still doing it? Okay. Okay. All right. So that's it for that problem. Another problem might say then they would tell us what percentage of these, right, were uncollectible, and then we would multiply the percentage by each of these totals and get the total amount uncollectible. That's what they're trying to teach us here. All right. So let's for this chapter, our analysis for decision making, um, financial ratios uh, include the accounts receivable turnover, which is just our sales divided by our average accounts receivable. So sales is sales, average accounts receivable is accounts receivable at the beginning of the period plus accounts receivable at the end of the period divided by 2. So the average accounts receivable. And then the other is what's called days sales in receivables, which is our average accounts receivable divided by our average daily sales. Average daily sales is sales divided by 365 if the period we're looking at is a year, right? If we were looking at a month, it would be sales divided by, for the month, divided by 30 or whatever, right? So these are our two, and what they measure, so accounts receivable turnover in essence says, how many times do we make sales equal to an average our average accounts receivable? So if our sales for a year were equal to our average accounts receivable, then our accounts receivable turnover would be 1. If we did 3 times as much sale as the amount that's owed to us on average, then it would be 3. Does that make sense? So what we're saying is, what is the relationship between our sales and the average amount of customer debt we're carrying for the customer? Okay. And this is a hard one to say, like what's healthy and what's not. It really depends by industry, but it is valuable to look at, say, your own compared to previous periods to be like, is the amount of debt, not our debt, but the amount of customer debt that we're carrying as an account receivable, is that going up relative to our sales or going down relative to our sales, and to notice patterns of that over time. And maybe in real life, you didn't want to set goals, right? And say, we don't want to have any more, we want to have our accounts receivable turnover be no more than this amount. And then the second one, days sales and receivables, since we're taking our average accounts receivable and dividing it by our average daily sales, in essence, what we're doing is saying, how many days on average are we carrying these accounts receivable? It's an estimate of that. Okay. So, all right. So they're related. And if your terms are like net 30, then you would hope for your days sales and receivables to be 30 or less, right? Like that would mean on average, people are paying you off when you are asking them to pay you off. So that's kind of how we look at that. All right. So last question. So our accounts receivable turnover, let's see, we have the Robinhood company. I wonder if they made this before there was an actual Robinhood company. We have our accounts receivable beginning of year, end of year, and our sales for each year. So determine the accounts receivable turnover for 2019 and 2018. Round answers and summers. Round answers to one decimal place. So I can do this by hand. I could also use Excel, right? If I wanted to put all this in. And then AR, beginning, and what's nice about Excel is I can just do like average accounts receivable. And I could just do equals average. Whoa, that was weird. Oh, because I put a negative in front of it because I was typing too fast. So that's kind of cool. Like I can just have Excel do that work for me. But I could also, like I could put in a formula like equals parenthesis, this, close parenthesis, divide by 2, right? And it would do the same thing. So once I know my average accounts receivable, then my AR turnover is just my sales for that year divided by my average accounts receivable. Whoops. Okay. So we could see that our accounts receivable turnover in 2018 was 11.8. And in 2019, it was 13.4. So what does that mean? What do you think? Yeah. Yeah. Well, it means that their sales is greater relative to their average accounts receivable. So not necessarily longer to sell things, but more sales for the same amount of accounts receivable. Okay. So if you think about this as just a fraction and you have sales on top and average accounts receivable on the bottom, if the number goes up, it's like saying we have more sales relative to our accounts receivable, which either means or sales went up and accounts receivable stayed the same, or accounts receivable went down and sales stayed the same, or some combination of that. So yeah, good. And then determine the day's sales in receivables. So the formula for that was, I just forgot it. Who wrote it down in their notes? What was the formula for days sales and receivable? So that would be our average accounts receivable divided by, and then I'm going to put a parenthesis and do sales divided by 365, right? So the sales per day is sales divided by 365. So in the numerator, I've got average accounts receivable. In the denominator, I have sales divided by 365. So what this means is I'm collecting an amount equal to my average accounts receivable every 27.24 days. They want one decimal place. So we'll let Excel do the work for us. In 2018, it's 30.9. In 2019, it is 27.2. So what does that mean? What do you think? That number is getting lower. Help me interpret that. You stretched. I was about to call on you. Thought you were raising your hand. So if my days sales and receivables getting smaller, getting lower, what's that? It's favorable because it means we're collecting the money owed to us a little faster. 3 days faster on average or so, 3.7 days. Or well, 2 point, never mind. Yeah, 3.7. So what we're looking for is in real life, guys, what you want to be able to do is collect the money owed to you as quickly as possible, typically, because an account receivable is an asset and cash is an asset, but those two assets aren't made the same. I can't pay my employees with accounts receivable. I can't pay my suppliers with accounts receivable, but I can pay them with cash. So when I convert accounts receivable into cash by collecting, I have taken an asset that is less liquid, less usable, and turn it into an asset that's more usable. So typically speaking, we want to have a higher accounts receivable turnover, more sales relative to what's owed to us, and a lower day sales, day sales and receivable. Okay. All right. I hope that was helpful. I hope you have a terrific day, and I'll see you tomorrow.